Three things move mortgage rates this week: the Fed's, oil, and labor market. One, kept pressure on rates. Two, added inflation risk. And three, matters for refinance opportunities could look like later this year. I'm Cathy Sabater, and this is your Thursday Market Watch. First, the Fed. The Fed kept its short-term rate where it is today between 3.5% and 3.75%. Think of the Fed rate as the bank-to-bank money, not the home loan rate. So what does this mean for a buyer? It means borrowing is not getting easier yet. The Feds did not lower its rate, and that keeps the overall rate environment elevated, which makes it harder for mortgage rates to come down quickly. In plain English, the Fed is still being cautious. That usually means mortgage rates may stay relatively high for now. The Iran conflict, that's number two, pushed oil prices up again this week. Last week, it was around the low 90s. This week, it's briefly around $119. That kind of jump matters because higher oil can raise inflation risk. And when inflation risk goes up, mortgage rates usually face more pressure. That helps explain why bank rates' weekly average for the 30-year fix rose to 6.27%, up from 6.19% last week. That is still below the 52-week average of 6.5%. Number three, the labor market. The morning's jobless report came in at 205,000, lower than expected. That told markets that the labor is still stable and that it makes it harder for mortgage rates to drop. Let's do a rate trend versus last week's bank rates weekly rate for the 30-year fix, which is around 6.27% compared to 6.19% last week. A $700,000 comparison from this week's rate move could reduce your purchase power approximately $4,400. That's principal interest only. Okay. Buyers are still in a slightly better market than they were a year ago because homes have become a little more affordable. But this week is a reminder that rates do not move in a straight line. Correct? NAR, National Association Realty, says affordability has improved for the eighth straight month, while also noting conditions could reverse if higher oil prices push rates back up. What about the seller's view? This is not a crash. It is more like a normal market. NAR reported 3.8 months of inventory in February. And Redline reported the typical home stays in contract, about 66 days on the market, up from last year. Well, you still have an opportunity, but price, prep, and negotiation matters more. The biggest section right now is buy to sell and move up buyers. This is the category that needs the most strategy right now. A more balanced market can improve contract structure even when rates are not ideal. Since homes are taking longer to sell and there are more homes on the market, move-up homeowners may have more room to negotiate credit, timing, and other terms that they didn't have in a tighter market. Weekend advice: if you're buying this weekend, do not wait for the perfect headline. Focus on your payment, a lock strategy, and whether seller pay costs can improve your math. If you're selling, price for the market right now. If you're selling to buy, this is a structure market, not just a rate market. I'm Cathy Sabater. If you want a personalized game plan for buyers, sellers, or move-up homeowners, reach out and let's map it out.